How are we getting on, people? Luke here from LAGFX, back today with another Learn to Trade video. In today's video, I am going to be going over chart patterns. What I'm going to do is create a mini series based on all of the chart patterns that I have used or use when I look to analyze and execute positions on the market. The first set of chart patterns I'm going to go over with you today are double tops and double bottoms. I thought I would start with this pattern as this is probably one of the most commonly used patterns in the Forex scene, and it's probably one of the most reliable as well. As we can see on screen, on the left side here, we have a double top. This is a clear drawing of a double top pattern. Here we have a double bottom pattern. Now, the first things that we need to distinguish when we look at finding valid chart patterns like this is that they are delivering us with the correct structure in order to be seen as valid. So in double top and double bottom patterns, what we'll see 9 times out of 10 is tops or bottoms that are either equal to one another in terms of height, or the second peak within a double top is either lower than the previous one, or in a double bottom, the second trough is higher than the previous one, like you can see on screen at the moment. Now, this pattern coincides very well with structural laws, and I'll explain why later on in the video. But if we quickly just talk about the laws of structure, when we look at bullish structure, we know that it produces higher highs and higher lows in the market. As we can see, the lows are protected and the highs break every time, creating new higher highs. Then when we look at bearish structure, we see lower highs and lower lows being introduced into the market. Again, the highs are protected in this case and the lows are broken every time. So keep that in mind when I'm going through these patterns here, as they coincide very well with our confirmation that these structures have been produced within the markets that we look at. Now, another thing to take note of when we look at distinguishing these patterns is that we will often find that a double top is formed at the end of a bullish move. And this is because the bulls in the market have become exhausted and the pattern itself distinguishes a potential reversal in trend. So we would look to be selling into the market if we were presented with a double top. Now, on the opposite side of the spectrum, we would often see a double bottom be produced at the end of a bearish move. And we can expect that a potential reversal is inbound and we should be looking to buy into the market. So when we see a double top, look to be selling. When we see a double bottom, look to be buying into the market. Now, there are a few things that we need as added confluence in order to place a position. We shouldn't be placing positions just because price has provided us with a double top or a double bottom. We need a few other things to ensure that our probability is high enough to be profitable in the trade and that we have the right confluence and confirmation that price is going to play out as we predict. So my number one rule when placing positions is to always trade with the prevailed trend. Now, what I mean by that is, if in doubt, zoom out, look at the overall structure of the market and ensure that the position you are looking to place coincides with the overall direction of the market. So if we are in a bearish dominant market, we are obviously wanting to be looking for a double top. If we are in a bullish dominant market, we're obviously wanting to be look for a double bottom. Now, you might be wondering, where will these patterns be formed? Well, these patterns are usually formed, as I said, at the end of bullish or bearish moves, depending on which pattern we're talking about. But these areas in the market can actually be predicted by the use of the Fibonacci retracement tool or order blocks if you have good knowledge in terms of that aspect of trading. Now, when we look to use the Fibonacci retracement tool, we'll always mark A through to B, and this will give us C. A is the start of an impulsive wave, B is the end of an impulsive wave, and C is the zone or area that price could trail up to before taking its reversal moving forward. Now, when we look to trade these patterns here, the traditional way of trading is to actually execute a position as soon as we have seen a break in the neckline, because this distinguishes the confirmation that we need in order to sell or buy into the market. So in this case, being a double top, we would be looking to sell into the market somewhere here as soon as we have seen a break in this neckline. Reason being, in a bullish market, as I said earlier, we have higher highs and higher lows. So we would look at this as a high being set, a higher low being set. We would expect a higher high to be created, a higher low to be created, and a continuation in this. Now, when we don't see that and we actually see a lower high get created, this is the first suggestion that the bulls are becoming weaker in the market and the bears are actually taking over and gaining dominance in order to push that price lower. Our confirmation comes when we have a break in this structural low. So when we see structure break to the downside, this is the confirmation we need that price is in fact looking to reverse, and then we can look to execute those positions. Now the opposite for a double bottom, in bearish structure, we see lower highs and lower lows get created. So when we see a low being set, a lower high being set, and then we actually see a higher low being set, this contradicts your bearish structure, as this is suggesting a potential reversal to the upside. We get confirmation of that when this structural high here, this protected high, is actually broken above. So this is considered a break of structure. As we know, breaks of structure happen when we see reversals in trends. If you don't know about breaks of structure, I have actually got a video on that, which I will link in the description. Go and check that out. It's a very good watch. So we've had a break in the structural high. We've had a break of this neckline. That is the confirmation we need in order to execute a position. So we would have our entry somewhere around here. Now you might be wondering, well, Luke, where do we place our stop loss? Where do we place our take profit? Now, traditional traders would place their stop loss either above the last structural high within a double top or below the last structural low within the double bottom. Those who are more aggressive with their approach to executing positions may set it halfway between the lower high that was created and the neckline. Again here, somewhere around here, below the higher low that was created and the neckline. Whereas I actually like to wait for a retracement to get more of a refined entry where I'll then look to place my positions and ride that price lower. Again, wait for that retracement. As soon as price is retraced and shows signs of its next impulse, that's when I place my position. Now, as we can see from these two diagrams, the traditional way of trading can offer you with some great returns, don't get me wrong, but I feel like it's very outdated, and I feel like there are much better ways of maximizing those profits and minimizing those losses. So what I'm going to do is take you over to another diagram that I've drawn out, one that has more detail to it, and I'm going to give you my exact coordinates on where I would look to execute a position and my placement of my stop loss and take profit. So as you'll see on screen, I have a green box highlighted here. This just signifies a zone that I am looking for price to reverse from. So this could be an order block. This could be a Fibonacci retracement zone. Anything you look in order for potential areas or zones to reverse from. It might be an area of resistance, an area of supply, whatever it is that you use to find areas of potential reversals. This is what that represents. What we have seen is bullish structure being introduced into the market. We have a high set, a higher low set, a higher high set, okay? Then we have a higher low set. So we expect a continuation, so another higher high to be set and another higher low to be set. But what we see actually is a lower high get created. Again, our first suggestion that price is moving bearish because this is disregarding the laws of bullish structure. We then see a break in structure as price comes down to create a lower low. This is the protected low, so this low shouldn't be broken, but it has in this case. So this has created this M shape, which is our double top pattern. Now, by any means, those who trade traditionally will have entered here with those pending orders. Me, I like to wait for that retracement. Now, this zone here highlights an order block that I have found in this regard, obviously using this example. What I'll do is I'll wait for price to trail into this zone. Give me the evidence I need that price has tapped in, shown rejection and started to move lower. As soon as I have that confirmation, I'll execute my position here, for example. I'll place my stop loss above the structural high that's created here, and I'll have my take profit where I sees fit lower down. Now, as you can see from this position here that I've imaginally placed, my entry is here. My stop loss is literally just above this point. So we have a much more refined entry. My stop loss is much closer to my entry price, which means that my lot size can be a lot larger than one would be with a less refined entry. This obviously gives us much better risk to reward returns. So if I just highlight this, our entry point was here. My stop loss is just above this structural high that was created within this retest. And then I have take profit down here. As we can see, we are looking at 1 to 8 RR returns. I risk 2% of my equity per trade, so that's a 16% trade right there. If we go back to this diagram here, if you were to place a position based on the break initially, a traditional way of trading, and your stop loss was above here, and your take profit was the width of the neckline to the lower high, then you're probably going to find that your position is around a 1-to-1 RR returns. Again, if you have that more aggressive approach and you lowered your stop loss, you might look at getting a 1-to-2 risk to reward ratio. So as you can see, my way of trading, just waiting for further confirmation, we are able to get a much better risk to reward return. On top of that, we are enabling price to continue to play out and give us more confluence and more confirmation that price is in fact trading in the direction we want it to. So this doesn't hold as much risk when we place these positions, and it completely alleviates any emotional attachment to the trade or any emotional misjudgment that we might experience if we placed a position like so. Because say, for example, we executed a position here, but then price came to actually trade back up to clear any remaining liquidity within this impulse down. Whilst price is in a drawdown somewhere around here, if you are not mentally strong and you struggle when placing positions to stay mentally strong and you find yourself making impulsive decisions based on what the market is doing, you might actually close a position up here because you're worried that your stop loss is going to be taken. This might bring on more emotional stress and worry, which is just not ideal when trading. You want your trades to be completely stress-free, and you don't want any emotional attachment to your trades. So when you place a position like this just encourages more emotional damage and more of that impulse to take further action with the trade. It brings on doubt and many other emotions. So as we can see, this way of trading, waiting for further confirmation, alleviates all of that, but on top of that, more than anything, gives us a much better risk to reward ratio. Now, I hope that makes sense. I know I've kind of taken priority with your double tops, but the same applies for your double bottoms. What I'm going to do now is show you a live example that I have actually done with a live market from a trade that I placed maybe 2 years ago. And I'm going to run through step by step exactly how I went on about tackling the market and profiting the way I did. So as we can see on screen, we have clear bullish structure being introduced into the market. Higher highs and higher lows. That's exactly what we expect. We then have a higher low being set here. We expect a new higher high to be created, but what we actually get is a lower high. So again, this is our first signs of potential bearishness moving forward. What then follows is a break of structure or a break in the neckline, as this is seen as a protected low. We then see price come lower than this, as we can see here. This is the confirmation that price is in fact ready to move bearish. So moving forward, we now know, okay, price has delivered us with the confirmation we need. Price is going to move bearish now. We need to look for an entry point. So what I did is I zoomed in on the market. I waited for price to continue to play out. Unfortunately, I missed the initial retest here. So what I did is I waited further. I waited for the new impulse to take place, which it did here. We waited for the correctional wave to take place. Now, whilst this correctional wave was taking place, I managed to find a point of interest, an order block that I believed was valid and I wanted to see price trail into before taking that impulsive wave down. What we could have also done is use the Fibonacci retracement tool. Now, if I just grab the Fibonacci retracement tool, I mark A, the start of the impulse, to B, the end of the impulse. We can see here that price taps perfectly into the 38.2, which is considered one of the golden ratios. So we could use that as confirmation. But me personally, I used an order block just to get that precise zone. Once price tapped in, I went down time frames. So we just go down time frames, continue to go down time frames. We zoom in a little bit. You'll see how this market set lows when tapping into this zone. So we had a low set here, we had a fractal low set here, which you can't actually see with that label, bear with me. Okay, this is a little bit better. So we can see these lows that were set in the market. So as soon as we had a break in these lows, okay, so this low here, that was enough confirmation for me that, right, okay, price has penetrated into my point of interest. It has delivered me with a break of structure within this. So now price must be ready to go on to take its next impulsive wave lower. All I needed to do then was wait for some kind of pullback in order to enter into the market. Now, as you can see, price created a low coming down here. Price came back up to set a lower high fractally. This is where I had another order block waiting. As soon as I saw price reject from this, I executed my position somewhere around here. Now my stop loss was set above the structural high. As I said in my diagram earlier, we want to set our stop loss just above the structural high, just to give us that safety, as this is considered a structural high and it's protected. And I had my take profit, if we just zoom back out, I had my take profit set at a higher time frame swing low. Now, as you can see, price played out perfectly and we took profit for the full 495 pips. Now, with a 25 pip stop loss and a 495 pip take profit, this generated us with a 1 to 19.75 risk to reward ratio. If you are risking 2% of your equity, you are looking at a 40% return from one position. Now, this is the beauty of using structural laws as well as chart patterns to distinguish positions that are placeable. All you need to do is implement all of these and you can find yourself an amazing position like this. Now, don't get me wrong, it's not as simple as that. You need to have a proper plan in place. But if you follow the simple steps of trading with the prevailed trend, waiting for the right amount of confirmation before placing a position, and having your stop loss and your take profit placement in correct places, you are going to be profitable 9 times out of 10. With this position here, I was following the prevailed trend. If I went to the week time frame, you would see that the Euro USD market is predominantly bearish. So we want to be looking for sell positions. As soon as this pattern had created itself, this M shape, as we can see, one high, the neckline, the second high, this is your M shape, this is your double top pattern. All we needed then was for the pullback. We got in on the pullback and then we executed and profited. Now, just to show you an example as to why my way of trading is a hell of a lot better than your traditional way of trading in terms of your risk to reward ratios and your, the fact that your probability in being profitable is a lot higher with my way of trading. Let me show you. So if we had our placement of our stop loss halfway, that seems about right. We had our take profit at the same point. We're getting a 1 to 1.55 risk to reward ratio. Now, don't get me wrong, that's nothing to be discouraged by. But when you can get a trade that's offering you 1 to 20 RR, I think you'd much rather place a position like that. Now, let's just say that you had your stop loss above the structural high. You'll see we're getting just under a 1 to 1 RR ratio. So as you can see, my way of trading is a lot better, a lot more refined, a lot safer, and in all honesty, can offer you with a much higher win rate. As you can see from this position, our trade didn't go into any kind of drawdown. It went into instant profit and stayed that way until profit was taken. Whereas if we were to place a position here, straight from the break of the neckline, we would have seen that a drawdown would have taken place before we even went into profit. Now, before I do end the video, I just want you to take note of these 5 things here. So always trade with the trend. Wait for a break in the neckline or a break of structure to the downside, upside, depending on whether it's a double top or double bottom. Make sure that you have found a valid zone to trade from. So a valid zone where that price can pull back into, where you can look to enter. So use that Fibonacci retracement tool, use your knowledge with order blocks, and always ensure that price has produced you with that M shape or that W shape, depending on whether you are looking at double tops or double bottoms. Now, I wanted this video to be quite brief, quite quick. I just wanted to get straight to the point, show you how I look to trade these patterns, give you the core basics of double tops and double bottoms. If you are struggling to still understand how I look to trade them, drop a comment below or join our Learning Lounge group chat. Drop me a message personally and I am more than happy to guide you through a live example. Now you'll notice that I didn't just find a double top and place a position based on that. I implemented many other factors to help build my bias, because at the end of the day, when we are placing positions, it is all based off probability. So the more probability you have, the more pieces of confluence that you have to back your trade, the better. Now, I hope you've enjoyed this video. If you have, don't forget to leave it a thumbs up. All the support you guys provide is very much appreciated. What I want you to do now is go into the comments and let me know what pattern you would like me to go over next, and I'll cover that in the next Learn to Trade video. Thank you guys for watching, and I'll see you all in the next one.